In this lecture, we'll take a look at investment planning and funding of major goals. By the end of this lesson, you should be able to discuss strategies and products that you can use when formulating your client's investment plan, and explain the process of funding a major goal, such as funding the costs of higher education. Before you can start to develop your investment strategy, you need to understand your client. What are the client's circumstances, their goals, needs, and objectives, their tolerance for risk, their preferences and constraints, investment experience, and time horizon. You need to understand the client's current financial situation and capacity, including their income, projected incomes, their assets and liabilities, and where those investments are positioned, net worth, and their outflows. And as just mentioned, constraints and preferences certainly play a part in understanding your client. You need to understand their tax situation, liquidity and income needs, what they're planning in the future is major expenditures, their preferences in regards to investments, and those which need to be avoided. One of the places you want to start is by taking a look at the current portfolio. What does the entire taxable and investment and tax-deferred portfolio look like? Are those allocations, the current asset allocations, aligned with the client's risk tolerances, and are they prudent? Are any of the security positions oversized? And what I mean by that is one security might be a large percentage of the overall investment portfolio. And if anything was to go wrong with that one security, it would be a sizable loss. And of course, liquidity. Making sure that there's adequate liquidity so that those investments, which are positioned for long-term growth, will not have to be sold at an inopportune time. Your strategy will certainly flow from your own firm's or your own investment philosophy. In Business 593, Investments and Portfolio Management, you studied in detail modern portfolio theory. The idea that asset allocation is the most important decision. And once you identify those asset allocations that are appropriate for your client's needs and circumstances and risk tolerances and all those issues, then within those asset allocations of stocks and fixed income and real estate, etc., there's proper diversification among securities. And you also learn that given an optimizer, given the different asset categories and inputting of expected returns, standard deviations, and correlations, we can come up with an efficient frontier. That portfolio which represents the highest level of return for a given level of risk. You also have heard along the way the idea of life cycle investing. And many advisors are moving or leaning more and more towards this philosophy. In life cycle investing, the idea is that there are financial assets and human capital assets. In other words, the ability of our clients to generate income. And as you probably recall, a younger client with a longer work horizon has the ability to invest in financial assets more aggressively because their work is generating systematic incomes for living needs. As someone approaches retirement and their future earning capacity is smaller, then financial assets need to shift from growth to more of an income orientation. Again, to provide that systematic income, which previously was a part of earnings. And we can think about, let's just say someone in their 40s or so, maybe you're recommending a 60-40 mix, stock to bond. Someone in their 20s could easily accommodate an 80-20 mix, 80% growth, 20% perhaps fixed income. and someone in retirement may have to completely shift that and go 30% growth and 70% income. It's that idea of life cycle, that those allocations shift upon where someone would be in their life cycle in relation to financial assets and the ability to produce income. You may have also read a really interesting article, I think, on Beyond Markowitz, and that idea was, well, we have a combination of modern portfolio theory and some of the life cycle pieces there, and that is we'll develop a core portfolio of fixed income and securities that replaces that ongoing earnings in retirement. Then there's a growth portfolio based on modern portfolio theory, and finally a small percentage of the assets can be put into a very aggressive portfolio that the author refers to as aspirational, and that could be venture capital, a privately owned business, that sort of thing. So again, you need to be starting from here in developing strategy. What is your overriding philosophy? Well, there are many different investment strategies that you may employ in working with your client and helping them move to their goals and satisfying their needs. Among these could be the matching of assets against liabilities, in other words, duration matching, bond ladders and barbells or bullets, a strategy of market timing or perhaps dollar cost averaging. Will you employ active management within the securities, for example, actively manage mutual funds, or will your strategy be buy and hold passive strategies? Will you employ fundamental or technical analysis? What's your strategy referring to portfolio rebalancing, portfolio hedging? What types of securities will you be putting in the portfolio? Will it be growth or dividend paying securities? Will you be employing a strategy such as covered call writing? So here's some examples. And again, these are not exclusive. You may be mixing and matching in putting together your client's overall investment strategy. There's a variety of products out there, and clearly I think one of the opportunities for financial planners is the complexity and the diversity of products. That's a lot for a client who's not educated and focused on this area to understand. You bring that expertise. Now clearly many financial planners build the investment portfolios with a combination of mutual funds and exchange traded funds. But you may decide to also use individual stocks and bonds, individual municipal securities and TIPS, REITs, which is the real estate investment trust, UITs, which are unit investment trusts, limited partnerships. You may be purchasing derivatives for the client's portfolio, bringing in alternative investments such as managed futures, private equity, commodities, and fixed and variable annuities. A few other considerations as you consider your investment strategy. And first is, I think it's important that you view the client's entire asset holdings holistically. You need to take a look at what's in the tax deferred accounts, the taxable accounts, real estate, including the residence, to get a feel of the overall asset allocation at this point in time. You can get a distorted picture by just looking at maybe the account that you're working on. So I believe that holistic view of their entire investments, their entire set of assets, is an important consideration. In working with couples, you're going to run into the situation where spouses have different risk tolerance profiles. You need to decide how are you going to deal with those varying risk profiles. Are you going to keep separate portfolios? Are you going to blend with a mix which represents perhaps an average or a balance between the two? You'll have to have that conversation with the client so that both spouses are comfortable with the portfolio. In our income tax strategy discussion, we talked about placing securities in different portfolios, the taxable portfolio, the tax deferred, the tax free portfolios. And that's something certainly you can add value by considering how you'll do that. One of the consistent tasks that you'll be involved in working with your clients is helping them fund for major purchases. And some of those include funding for education, purchasing a home or maybe a second home, a vacation home, planning for a major family trip, perhaps purchasing that new car, that new boat, planning for a wedding, and consumer durable goods, which cost more than just a portion of a monthly paycheck. And in doing that, when working through the process of helping your client plan for these major expenditures, you'll need to be thinking about the projected cost, the time horizon, the rate of return on the savings account, the current savings that you might have that you can put towards this major purchase, and then calculating the contributions necessary to get there. So let's take a look at educational funding. You're given, and as you studied in your core fundamentals of financial planning course, Business 501, you looked at educational funding, and some of the vehicles are out there for you to invest for savings, in many cases on a tax advantaged basis. And they include the 529 plan, whether it's the savings plan or the prepaid plan, the Coverdell educational savings account, some CDs perhaps that allow you to somehow align with the growth of education. There could be custodial accounts now, such as the UTMA, the UGMA. There can be minor trusts. There can be personal savings accounts, use of savings bonds. And this list of vehicles certainly span from tax advantage to simply taxable accounts. And the idea that perhaps you want a combination of the two. So that if the child receives scholarships or some other monies, then perhaps by splitting between a tax advantage and a taxable account, then the tax consequence for not using some of those funds towards education would not be as severe. Note, as you know, direct payments to an educational institution by relatives or others would not have any gift tax implications. Let's take a look at the process of funding education, because the process of funding education would be identical to the process of funding any major expenditure. You need to make some assumptions about the time horizon, the objectives of the client. You need to project out what that cost will be, and in this case of education, we'll look at the current annual tuition rate. We look at the educational inflation rate. That will then allow us to project out what that cost will be for the freshman, sophomore, junior, and senior year. We need to understand the time horizon, the reinvestment rate on savings up to when the withdrawals occur, and any other applicable assumptions. So let's look at this question. How much should the client invest at the end of each year to fund 4 years of college, given these assumptions, this data? Well, the first thing you need to do is project out that cost, and that's what we're doing. The current cost in this example was $15,800 per year. 15 years at a inflation rate of 6.2, and you can see the freshman year cost is $38,951. You can see what it is for the sophomore, junior, and then by senior year it's all the way up to $46,655. At this point in time, assuming that contributions will be made up to beginning of freshman year and then stop, then we can figure out what's that lump sum need. And in this case, we are discounting those costs at the reinvestment rate during the college period. You can see it's 5%. And in building this example, the idea was that you're shifting from a growth portfolio to a conservative portfolio because you'll need those funds. And that's why we're seeing that in today's environment, it's going to be even less than 5%. But you can see the lump sum needed is 158,497.61. Knowing that, we can put that in as the future value. We can figure out the number of periods, in this case 15 years until that start of freshman year. The reinvestment rate during the growth period is 8.5%. Currently, we're assuming that there are $0 put away for savings, and then we move to the idea that we can solve for what is that annual payment at the end of the year, and you can see that it's $5,614.06. As I note here, if there were any savings, you would put that into the PV. You would have to put that in as a negative number. In other words, that's already come out of your pocket. Strategies for funding educational shortfalls. So given enough time until the start of college, and enough time means enough time the compounding can kick in a little bit, you can recommend that increased annual contributions will be needed. You might be able to reallocate the portfolio for higher expected growth. So in our example of 15 years and 5 years in, we realize that we're falling behind. With 10 years to go, you might have the ability to do that. With 2 years to go, you wouldn't. You might have the idea of reassessing the school of choice. Would the parents be willing to adjust their objective of fully funding 4 years and maybe partially funding? The child could participate in the funding via work study or taking out student loans. Of course, the idea of maybe attend 2 years at a junior college and move to another college. The idea here is that it's a conversation. You can have those discussions about, will you be reaching that goal based on what has been done and the amount of time and what can be done based on the budgets and all. You need to have those conversations. Now, given a short-term window where there's not time for that compounding to kick in, then there's a variety of options for education. Possibly grants if there's extreme financial need. The child may qualify for scholarships, whether it's academic or athletic. There's student loans, and you already know about these, or work study. So in this discussion, we took a look at investments and that idea that we need to understand our clients first. And clearly, we need to have our overall philosophy. And within that, we can start to develop strategies and implement with investment products to help that client move towards their goal. Similarly, you'll be working with your clients in helping them figure out how they can save and invest for major purchases.